The ASX 200 closed Thursday down 0.57% at 8,793, and the damage was almost universal. 10 of 11 sectors finished in the red. Mining stocks took the hardest blow. The materials index dropped more than 1%. Banks fell for a 9th consecutive session. Consumer staples slid. Gold shares dipped. The only exception was energy, which climbed 2.5% as oil pushed back above $100 a barrel on fresh Middle East tension. That divergence told the story of the day. While oil-linked stocks like Santos and Woodside caught a bid, the rest of the market was absorbing bad news on multiple fronts. Santos reported first-quarter revenue of $1.27 billion, up 3% from the prior quarter, with production of 22.5 million barrels of oil equivalent. The shares rose more than 3%. Woodside held its annual general meeting in Perth, where climate protesters stormed the stage with whale noises, yet the stock still advanced as energy sentiment carried it. Elsewhere, profit warning season was gathering pace. Cochlear became the session's most dramatic casualty after the hearing implant company slashed its full-year profit guidance from $435 to $460 million, down to $290 to $330 million, a cut of roughly 30% at the midpoint. Morgan's dropped its price target from $214.93 to $107.17 and shifted to a hold rating. For a stock long considered one of the ASX's more dependable healthcare growers, the reset was jarring. And it wasn't isolated. Australian market braces for significant profit downgrades, ShareCafe warned. Qantas faces an $800 million fuel bill. Woolworths is in federal court over allegations it misled shoppers with artificial price hikes disguised as discounts. A senior Woolworths manager testified that suppliers had actually requested those price increases and threatened to pull products from shelves if the supermarket didn't comply. The market knew it had a lot to process. It processed most of it by selling.
On the 5th floor of Commonwealth Bank's Axel building in Sydney, 6 workers are running what the bank calls the pollen team. They manage AI honeypots, automated bots that lure global scammers into real-time conversations, extract intelligence, and protect CBA customers around the clock. The Australian Financial Review called it a war room. CBA is genuinely proud of it. On the same day that story ran, CBA confirmed it was cutting 119 jobs. That number sits on top of 300 cuts announced in February, and 45 call center roles eliminated in 2025, when an AI chatbot absorbed customer inquiries. Of Thursday's 119 jobs, 6 were explicitly attributed to automation. The finance sector union called it adding salt to the wound. National Secretary Julia Angrisano said employees were peering down the barrel of another 119 jobs being wiped out, with seemingly no end in sight. Here is the part that matters. CBA's AI War Room is not replacing tellers. It is replacing the mid-tier white-collar workforce that used to handle fraud detection, customer complaints, mobile lending, and back-office coordination. The bank employs around 49,000 people and points out its total headcount grew by 2,500 last financial year. That growth was real, but it landed at the top, in engineering, data science, AI operations. The cuts are concentrated at the opposite end, roles in simplified workflows, where AI has made human judgment redundant. The bank is not shrinking, it is bifurcating. CBA is not alone in this. The same week, ANZ's new chief executive made headlines for rejecting the language of respect as a workplace value, framing decisiveness over consensus as the new operating principle. That cultural signal matters alongside the numbers. What is forming across Australia's big banks is not a downsizing story. It is a restaffing story, with a very specific shape. More AI engineers, fewer human operators, and leadership cultures designed for that transition rather than against it. The question the redundancy figures don't answer is what happens to the customers at the bottom of that funnel. CBA's AI fraud team protects depositors, but the 119 people being cut included mobile lending managers, the people who explain mortgage options to first home buyers, who navigate disputes for small business clients, who provide the human layer that automated fraud detection cannot replicate. When the bot catches the scammer, that is a win. When the lending manager is gone and the first homebuyer can't get through to anyone, that is a different kind of failure.
For the ASX, this dynamic will not resolve quickly. The macro setup makes it worse. Australia's inflation time bomb, as the AFR put it Thursday, is still primed. Barrenjoey chief economist Joe Masters was presenting to clients this week on the acceleration of price pressures since the Iran war began. 36% rises in plastic plumbing pipes, 10% in house paint, 20% in a liter of milk at Coles,
fuel surcharges cascading through construction and logistics. The RBA is pricing in a 72% probability of a rate rise after the May 5 board meeting. Higher rates make it more expensive to carry headcount. That is a direct tailwind for AI-driven cost reduction inside the banks. If the RBA hikes on May 5, expect more redundancy announcements in the weeks that follow, framed as operational efficiency. The banks will be correct that the math works. The harder problem is whether the workforce that absorbed those cuts finds an equivalent role, and whether consumer sentiment survives another wave of service degradation at the institutions Australians use most. The current evidence leans toward continued bifurcation rather than stabilization. CBA strategy is coherent on its own terms. Grow the technical core, compress the operational layer, protect margins against a rate environment that squeezes borrowers and lenders alike. That logic holds as long as credit quality stays manageable and customers don't defect to non-bank lenders or fintechs who compete on service. The break scenario is narrower but real. If Cochlear's downgrade signals that broader corporate Australia is entering a demand shock, not just cost pressure, then banks face both margin compression and rising loan impairment simultaneously. In that environment, headcount reduction accelerates further, but so does the risk of a customer trust collapse that no AI honeypot can intercept. Watch the May 5 RBA decision as the first benchmark. A hold keeps the current equilibrium under stress but intact. A hike changes the timeline for everything downstream, and the bank's next round of redundancy announcements will follow within weeks. What this Thursday confirmed is that the ASX's banking sector is not in a temporary adjustment. It is in a structural reshaping, and the market is not yet pricing the human cost side of that equation. Whether it needs to depends on a question the data can't answer yet. How many of those 119 people were the last line between CBA's customers and a service gap that the AI hasn't learned to fill?